Okay, good morning. Yes, you don't have to shovel the heat if it's 96. Great. Yes, but yeah, it's just nice not to have snow here. Okay, good morning. Today we are starting chapter 10. We finished up 9. We are ahead of the schedule by 1 day, and that's not a bad thing. That's a good thing because we don't have to go at a breakneck speed. We have a little bit of extra time, and that'll be useful later. Can you move whatever cursor's on the screen? Okay. Okay, so chapter 10 today, and starting off with what's due this weekend. What's due this weekend, what's due Saturday has to do with chapter 9 primarily. Chapter 9 homework, it doesn't take an overly long period of time. There are several problems, but they go pretty quickly. We have an attendance quiz that will be available, I'm guessing around 1 o'clock today. 1 o'clock. And chapter 9 homework. The attendance quiz covers chapter 9, so it's going to be pretty much Tuesday. What we do today will more than likely appear on next week's attendance quiz. It's possible there might be something today, but I think the attendance quiz is going to be primarily Tuesday and possibly last Thursday when we started chapter 9. So the attendance quiz this week is chapter 9, which is this Tuesday and last Thursday. And then the video quiz 21 over chapter 10 is due Sunday, and we are starting chapter 10 today, so you'll have a little bit of duplication. There'll be a little bit of overlap, which is not a bad thing either. Okay, so but before we start on that, I want to talk about one of my favorite subjects. What? Ever, yeah. So I want to talk about, just take a few minutes to talk about study abroad. Study abroad is a wonderful experience. What I've got here is a picture of my group. This is actually in London, and Brian is in the picture right behind Haley in the white jacket. So Brian's in the blue. You're very hard to see in that picture, but you're in the second row behind Haley, who's in the white jacket in the front row. Yeah, you should have just been, here I am. Anyways, this is the Institute of Chartered Accountants of England and Wales. It is in London. And I want to talk about study abroad both for accounting majors and then in general, because this is a really good thing to do. So that was the first year. That was actually 2 years ago when we went. And I've got some information coming up. This information is for accounting majors, and I'm going to talk about it in general as well. Every May this year I'm taking 24 accounting majors primarily to Paris and London. It's for 2 weeks. We leave the Sunday right after finals week. In May 2015 we'll be leaving the Monday after finals week, and we go for 10 days. We go 5 days Paris and 5 days London. It's for accounting majors because we do visit things like we talked about the International Financial Standards, Reporting Standards, International Accounting Standards Board. We visit that, for example, in London. But we have a CIS major going this year. We've had finance majors go in the past. I think I have an econ major going next year. So we have some interested others. It's not just accounting, but accounting is the title of it. The trip fee for going is $3,300. That covers your airfare, your lodging, all ground transportation, admission to the events that we go to there, and then it's a 3-credit-hour College of Business course. If you're an accounting major, it counts as an upper-level accounting elective. And it is 10 days, and I put 10 plus days because you have the option to add a few days onto it if you want to stay and go with friends that are also on the trip. If you want to tack on like Scotland or something, you can tack on extra days. That can be arranged. If you're interested in going on the study abroad for May 2015, believe it or not, we're taking sign-ups now. We actually have 4 people signed up for the trip next year. This year's trip, the one that I'm going on, is starting May 11th this year. It filled up in November. So if you're interested, this is about accounting study abroad specifically. Email me and I'll get you at least information about it. Also, from this College of Business standpoint, We can't make promises because we're not in that school year, but the last 2 years there has been scholarship money and they expect that to continue, and basically students get scholarships if you go, as long as your grade point's above 3.0, there's scholarships per student of $1,000 to $1,500 typically, and so that goes towards your trip fee. Study abroad, so now I'm stepping back. First of all, accounting, it's a wonderful trip. We visit public accounting firms. We visit, Grant Thornton is a firm here, international firm, but a lot of our students go to Grant Thornton here to work for internships and full-time offers. We visit Grant Thornton in England. We visit, this year we're visiting KPMG in Paris. We have an etiquette speaker on the, that we see on the trip, and it's a wonderful experience. Now, thinking about study abroad in general, if you have the opportunity to do a study abroad trip, no matter what your major is, I cannot emphasize enough what a great experience this is. There's the issue of on one hand you look at it and go, woohoo, it's Paris and London, and that's good in and of itself. But on the other hand, it does change your viewpoint. It makes your viewpoint definitely more global, and it definitely is an experience you won't forget. It's a wonderful opportunity. These study abroad trips that we have in the College of Business, there's other ones throughout the university that are short-term in nature. They're during intersession, so you don't miss any of spring semester and you don't miss summer semester. You can still get a job for the summer, and that's why we've squeezed it in there in intersession. So no matter what your major is, I would urge you to try to do a study abroad. It is a very good experience. And so anyways, so there's my, Brian went, and you, yeah, if you can't hear him online, he said it's amazing. Yeah. Yeah, he wants to go back. So, yeah. So it is wonderful. That I cannot say enough good about this. And it is 2 weeks. You're extremely tired by the time you get home, but it's a really good experience, and we learn a lot. And yeah. Okay. So there's my commercial for study abroad. So if you're interested at all, send me an email, and I'll get you information. Okay, so now we're moving on to subject matter. Okay, stockholders' equity. Okay, so up to before today, we've gone through all the assets. So we did cash, we did accounts receivable, we did inventory, property, plant, and equipment, investments. Chapters 9 was liabilities. So now we're down to the section of the balance sheet called stockholders' equity. So that's what we're talking about for this chapter, is stockholders' equity. Now, you haven't watched the videos on stockholders' equity, so I'm going to talk a little bit about the chapter now. This, I think, is a fine chapter. This is one of my more favorite chapters, although it is very specialized. In this chapter, it starts out with talking about the features of a corporation. Then we talk about issuing stock, which we've seen a little bit of. We talk about treasury stock, and then we talk about retained earnings, dividends, and splits. So we have we're talking about everything in that stockholders' equity section of the balance sheet. Okay, so I'm just going to talk right now on the slide about each of those items. First of all, features of a corporation. Corporations are the only ones that have stock. Okay, we have stock in a corporation. So a corporation is a legal entity all by itself. It has almost personhood status. So a corporation has this legal existence, so it's treated as its own one entity for tax purposes. If you have a sole proprietorship or a partnership, for tax purposes, that's taxed at the personal level. So it goes on your personal tax return under a Schedule C for a sole proprietorship, or a partnership return for partnerships. But a corporation files its own tax return. And the corporation then can be bought and sold. We can transfer ownership easily. Partnership and sole proprietor, you cannot transfer ownership. It basically dissolves it and you start over. So corporation, easy to sell, to change hands, change ownership. Corporation, the owners are not personally liable, and that's a biggie. because it is its own legal entity. If you're in a partnership or a sole proprietor, you're personally liable for the business. So those are those main features of a corporation, and that's why so many companies find it desirable. Also, from a standpoint of a corporation, we have something called double taxation. We say that if you have a corporation, those corporate earnings are double taxed. And the reason we say they're double taxed is because a corporation files its own tax return. So it pays tax on its own earnings. And then a corporation will pay stockholders dividends. And that's how that's one of the ways stockholders get money and get a return from their investment is through dividends. So when a stockholder gets the dividends, which is income from the corporation to the stockholder has to pay tax on those dividends. So the income the corporation makes is taxed at the corporate level, and then it's also taxed when they pay a dividend. So that's why we say that corporations are subject to double taxation. Now, not all corporations pay dividends. There is a whole, you could study dividend theory for an entire semester because it's very complex as to why a corporation pays dividends and why it doesn't. If a corporation pays dividends, let's take First Energy. First Energy owns Ohio Edison and other electric subsidiaries. First Energy pays a dividend, and they pay a regular dividend. That's because investors, when they invest in a utility stock, typically expect a return in the form of a dividend. So in the utility industry, when investors buy that stock, they're expecting a dividend. This is not every utility stock, but that's generally, you can kind of take a broad brush and say that about utility stocks. So that's built in to their price. Utility stocks typically aren't skyrocketing neither. So investors are saying, I'm going to get a lot of my return on this utility stock through the dividend because the price isn't subject to go way, way up. And sometimes it does, and investors earn money because of the increase in price. On the other hand, let's say you had stock in a startup company. A startup technology company does not have cash typically to be able to pay dividends, nor do they have income. They're in startup mode, so they're not earning anything. And so typically, in many cases, a startup company will not pay a dividend. But as an investor, you're investing in that stock because you want to get appreciation in the stock price. You think the stock price is going to go crazy over time, so that's why you invest in it. So as an investor, we're looking for either a dividend return or a stock price increase. And that's how as an investor, we make money from investing in stock. So, but there's no way to tell what company will pay dividends. There's no way to predict stock prices. So this is all an educated gamble when you invest in stock. Okay, so now we go into Learning Objective 2, issuance of stock. Whenever you see an IPO, you see a lot of things that have IPOs. For example, Candy Crush Saga, Candy Crush, the game. I'm going to look like I play a lot of games. We were just talking about 2048. Okay, Candy Crush just did an IPO. So you look in the news and it says Candy Crush King. King is the owner of Candy Crush Saga. Just did an IPO. And what they did is they went to the market and they said, here, buy our stock, basically. And that's IPO stands for Initial Public Offering. You do not need to know that for this class. But just so you know that that's when you see a headline that says IPO, it's Initial Public Offering, they're issuing stock. So they're doing what Learning Objective 2 is talking about here. So King went to market and issued stock. Up to this point, King only had money from investors who had given it money, angel investors or other interested parties, so it was private. So they didn't do a public offering up to this point. Up to this point, the owner of Candy Crush app has been private. They've gotten funding from various investors, but it is a private equity holding. Then they decided that, boy, we're making money. They're making something, they get millions of dollars every day from in-app purchases. So when you hit a certain level in Candy Crush and you pay 99 cents to unlock the next level, they're making millions and millions of dollars every day from that. So at some point they say, our private investors aren't going to give us any more money. We need more money because we want to expand and do more games. So they say, let's go and do a public offering, because then now the whole world can buy shares of King. So we buy shares of King. As an investor, I can go buy shares of King, so I too can own part of the action for Candy Crush. So a company, when it issues stock, is saying to investors, give us money and we'll give you stock. And as an investor, I'm in it for two reasons. I'm in it either for a dividend or for an increase in its market price, or both. So that's what we're talking about when we talk about issuing stock. Now the next one down, treasury stock. Treasury stock is an interesting animal. It's completely different than the rest of it. Treasury stock is when a corporation goes and buys its own stock back. So it goes to the market and buys its own stock back. So let's think about this. A popular company, not popular, well-known. We all know what Crocs are, the shoes, okay, the ugly shoes, but quite comfortable. Yeah. Yeah. So anyways, Crocs has been struggling. Crocs has been struggling because the population is not buying Crocs like they were at the height of Crocs fever. So Crocs has been trying to expand into different kind of shoes. Now Crocs has dress shoes and other things. But so Crocs has been struggling. And in the meantime, as they struggle, their stock price has been going down, tanking. So Crocs recently made the news because Blackstone Group, which is a group of investors, recently made a deal with Crocs to give Crocs $200 million. And this $200 million that Crocs has, they are going to take that $200 million and buy back their own stock. And why are they doing that? Well, they're doing that because if they buy back their own stock, then there's fewer shares outstanding, which means the value of each outstanding share is higher. When a company buys its own stock back, that no longer counts as an active outstanding share. You cannot own yourself. So if a company goes out and buys 200 million shares or whatever it's buying, it has just reduced the number of owners of its shares. So now each of the remaining owners of Crocs owns a bigger piece of the pie. So Crocs can prop up its stock price this way. There's other reasons companies would buy their own stock back. Another common reason a company buys its own stock back is you've heard of employee stock ownership plans, where companies reward their employees with shares of stock. So to reward their employees with shares of stock, they have to get that stock from somewhere, so they go out in the market and buy it. So Crocs just went out and bought 200 million of its own shares back. And what they're doing is they're propping up their stock price for the remaining shares. Now, Blackstone Group gave the Crocs 200 million, and they didn't give Crocs 200 million for no reason. Blackstone Group then is getting from Crocs, when they give Crocs their 200 million, Crocs is issuing them this interesting stock instrument called convertible debt. So, or preferred stock, I guess they're using preferred stock. So they're issuing them convertible preferred stock. And what's happening with this convertible preferred stock is Blackstone now has 200 million of convertible preferred stock. What does that mean? Well, the preferred stock will pay Blackstone a small dividend. Okay, but Blackstone wouldn't do this deal for this small dividend. It just kind of makes them happy for the next 2 years. But this preferred stock has this convertible feature on it, and this convertible feature allows Blackstone in 2 or 3 years, at some point in the future, if Crocs stock price hits certain targets, Blackstone Group can trade their preferred stock for the common stock. They want the common stock because the common stock will increase in price. So basically what Crocs is hoping and what Blackstone is hoping is, let's say for example Crocs is selling for about $22 a share right now. So Blackstone gets all this preferred stock. Preferred stock looks more like debt. Preferred stock says we'll pay you a 1% dividend forever. So preferred stock, you don't get a higher dividend, your stock price doesn't go up. So right now, common stock is selling for $22. Blackstone Group is hoping then this $200 million investment it made, that 2 or 3 years from now, due to all these actions that Crocs management is taking, that stock is worth, let's say, $75 a share. Because then Blackstone can take its $200 million of preferred stock and trade it for common stock and benefit from the stock price increase. So 2 or 3 years from now, that investment that Blackstone made is going to turn into profits for Blackstone Group, hopefully. But anyways, so that's treasury stock and that's preferred stock, an introduction to preferred stock. We'll see preferred stock more in this chapter. And then finally, learning objective 4, retained earnings. Retained earnings is a running total of all our income to date less any dividends we've paid. So that's kind of like a nebulous. It's not cash. It's not anything you can point to. It's just a running cumulative total. Dividends, when we pay dividends, we'll talk in learning objective 4 about how we handle that. And then we can also do stock splits. Google just did a stock split. Google just said our stock price is getting way too high. We're going to split it. And they did this crazy split that's kind of weird. But companies will typically split their stock when they think the price is too high. So let's say Amazon was selling for $1,000. If they do a 2-for-1 stock split, they'll just say, if you own a share of Amazon, now you own 2 shares. So everybody's shares double. So you don't really get anything, but it makes the price more attainable for more people. Okay, so with that, what we're going to do is I'm just going to go in and do a couple homework problems here, because then I can talk about it as we go. So we're going to start with short exercise 10-10. Okay. Short exercise 10-10 is actually about treasury stock. So what we're given is Marketing Corporation, Gelman Marketing Corporation reported the following stockholders' equity. So they give us all these stockholders' equity totals. Notice that it says it's in millions, so we just do the problem like this. We're not going to add 3 zeros to everything. We're just going with this. Now, the other thing to note here is look at what they've given us. They've given us common stock, so that's an equity account. Then we have another account called additional paid-in capital. Common stock has a par value or a stated value, and a par value is a legal amount. When a corporation files its articles of incorporation, it says our par value is whatever, like 1 cent a share, and that's considered its legal capital. This is a legal thing. So common stock always has the par value for a stock. Additional paid-in capital gets anything above par value that's paid for the stock. Par value is a legal term not associated in any way, shape, or form with the market value. And we'll see this in homework problems we do coming up. So we have common stock. You might want to put in parentheses that that's par value or stated value. So that's common stock. And then additional paid-in capital is amounts above par value that were paid to the company. Next down, retained earnings. Retained earnings, we said, is a running total of all our earnings to date, all our income to date, less any dividends paid out. Okay? And then finally we have treasury stock. Notice that treasury stock is a negative amount. It's got brackets around it. That will always be the case. If we buy stock, if we buy our own stock back, that reduces our stockholders' equity. We cannot own ourselves. So this company went out and spent $690 million on buying its own stock back, so that's treasury stock. Okay? Now, so those are our ending balances at the end of the current year, at the end of last year. So that's just kind of a balance sheet. That's what's going to be in the balance sheet. Now it tells us during the next year, Gelman purchased treasury stock at a cost of $22 million. Okay, so they purchased their own treasury stock for $22 million. So this has happened after this balance sheet balances, and resold the treasury stock for $15 million. And it tells us that the amount that they resold had cost them $4 million. So we want to record the purchase and resale of treasury stock. And then it asks us how much did stockholders' equity increase or decrease as a result of the two treasury stock transactions. Okay, so what we're going to do here is we are going to deal with the purchase of the treasury stock of $22 million. So that's the first thing we're going to do. Okay, so when we purchase treasury stock, it costs us $22 million. What's happening here, this company goes out and buys its own stock back. So when it goes out and buys its own stock back, it's getting treasury stock and it's spending cash. When we figure out what we're going to debit and credit, the easiest thing here is to think about what's happening to cash. If they went out and bought $22 million of treasury stock, they're paying cash out, so we have to credit cash. And then the debit is going to be to treasury stock. So this journal entry here that I'm showing, again, this is an excellent problem for on that reference sheet because you've got some very standard journal entries. So this right here is the journal entry. When we purchase treasury stock, very straightforward. We're going to debit treasury stock. We're going to credit cash for the cost. That's it. No calculations required. Okay, this is the purchase of treasury stock. Most stock, when we look at stockholders' equity, a normal stockholders' equity account has a credit balance. So a treasury stock has a normal debit balance and it reduces treasury stock. It reduces stockholders' equity. Okay, next up then. So our next transaction here that we need to write, we had to record the purchase and now we're going to record the resale. And that's the next line down where it says we resold the treasury stock for $15 million and the treasury stock had cost them $4 million. Okay, so they went out and bought $22 million of treasury stock, but now they resold some treasury stock and they're telling us that whatever they sold had cost them $4 million. So what we're going to do here, we know what we sold it for and we know the cost. So the journal entry is going to appear here in a minute, and we're going to be increasing cash because we sold it for $15 million, so that's how much cash we're getting. And then we have to reduce treasury stock for the cost. I'm going to wait for a minute while you write that down, and then we'll talk about it. What's going on here now? So we resold treasury stock for $15 million. So we're getting cash of $15 million in. So our cash is increasing. That's pretty straightforward. Then we need to credit treasury stock for $4 million because that's what its initial cost is. So you may want to make a little note because I'm thinking of your reference sheet for exams and homework. When you credit treasury stock, it's always for the cost of the treasury stock. So you're crediting treasury stock for the cost. That's what that number is. So cash gets debited for the amount of cash you're getting. We're increasing cash. And we're going to credit treasury stock. A credit to treasury stock reduces treasury stock for the cost. So then this last line, paid in capital from treasury stock transactions, that's the difference. That's to make our debits equal our credits. We cannot ever, ever, ever have a gain or loss on treasury stock transactions. We cannot have gains or loss on buying and selling our own stock. This just simply goes into paid in capital. And actually, paid in capital is a good name to know for that. Paid in capital, the end part of it can vary slightly. But paid in capital from treasury stock transactions, that is a stockholder's equity account. Stockholders' equity is increased with credit, decreased with debits, just in general there. So that is an excellent example. There's two journal entries of treasury stock transactions. We can buy our own treasury stock back, and we can sell treasury stock we own. We can reissue it. And then the last part here says, overall, how much did stockholders' equity increase or decrease as a result of these two transactions? We had two transactions here. We purchased treasury stock for $22 million, and then we resold it for $15 million that had a cost of $4 million. So we have to answer this. What happened to stockholders' equity overall? So we've got to go back through our journal entries. We purchased $22 million, so that would reduce stockholders' equity, the purchase. We sold it for $15 million, so that would increase it. And so overall, stockholders' equity decreased by 7. So you'll see I put brackets around the 22 to say stockholders' equity was going down. 15 was increased, it's a positive. So overall, our stockholders' equity decreased by $7 million. So when we purchase treasury stock, it causes stockholders' equity to decrease. When we sell treasury stock, it causes stockholders' equity to increase. So overall, stockholders' equity, that's what SE stands for, decreased by $7 million for these two transactions. Okay, next up we have 2 multiple choice questions, I believe. Okay. Next, so Casey's Computers purchased 4,000 shares of its own $10 par value common stock for $92,000. What happened as a result of this transaction? I'll go quiet for a minute or two until I see people done writing. Brian, what do you have?
2 A's, 1 B, 1 C, 1 D.
Okay, so a lot of not knowing. Okay. When we purchase treasury stock, I'm going to come back to this slide in a minute, but when we purchase treasury stock, I'm going to go back to the exercise that we just did. So I'll come back to this question, you'll see it again. But when we purchase treasury stock, what happens is we debit treasury stock and we credit cash, and it's for the cost, period. Okay? Treasury stock reduces stockholders' equity. Notice that we didn't need to know what the par value was. We didn't need to know anything else. So when we're talking about this question that we just had, when we look at our choices, we purchased 4,000 shares of its own $10 par value common stock. Is the $10 relevant? No, we don't need it. Treasury stock we record at the cost. So when we're talking about this, we can basically ignore a bunch of this question. There's things that get in the way, just like real life. We don't care that they purchased 4,000 shares. We don't care that the par value is $10. What we care about is they purchased their own stock back for $92,000. That $92,000 is going to decrease stockholders' equity. So the answer here is C. Okay, so we are reducing, when we purchase treasury stock, bottom line is we are reducing stockholders' equity for however much we purchased the treasury stock for. Okay, so we are going, answer C, When we make a treasury stock purchase, the entire cost reduces stockholders' equity. Next question now. So now we have another one. And this next one relates back to the second part of that exercise we just did. So I'm going to put it up, let you write it down and decide on an answer, but it does relate to the second part of that homework exercise we just did. Do you know it? Do you know it? Do you have answers? 3 B's? Okay, I got a B. So the answer here is B. And if we think about this question, let's go back to that exercise. So the question says if treasury stock is sold at a price greater than its reacquisition cost, so the cost to buy it back. We have that example in the second part of this homework exercise that we did. We sold the treasury stock for $15 million. It had cost them $4 million. So when we do this question, when we see that when we talk about reacquisition costs, that's just saying what did we pay for the treasury stock. So we credited that difference to paid-in capital. Remember that we will never, ever, ever have a gain or loss based on treasury stock transactions. Next up, we're going to do another homework problem. And this one's a good one. This one's about dividends. And this is another excellent example of journal entries that we would want on that exam reference sheet, or that we want for doing the Chapter 10 homework. In this exercise, it tells us that Greenwood earned net income of $85,000 during the year ended December 31st. So they earned net income. On December 15th, Greenwood declared the annual cash dividend on its 8% preferred stock. It tells us 20,000 shares with total par value of $200,000. And a 15-cent per share cash dividend on common stock, and it gives us information. And then they paid the dividends on January 4th. So we have to do the following 2 journal entries. Okay, we have to do the declaring the dividends and paying the dividends. There's 2 dates, there's actually 3 dates that are very important when we're doing dividends. The first date is the declaration date. Until a dividend is declared, a company never has to pay it. If a corporation if its board of directors does not declare a dividend, it doesn't have any legal obligation to pay a dividend on preferred stock or common stock. So even if a company has paid a dividend every year for the last 50 years, until its board of directors declares a dividend, it has no liability or obligation to pay a dividend. So we have the date of declaration. So in this case, the board declared the dividend on December 15th. There is another date that's not listed in this problem, and it's called the date of record. And you do need this. You do need to know what the date of record is. The date of record says we declare the cash dividend on December 15th. to the shareholders on the date of record of December 20th. I'm making it up. So let's say December 20th. The date of record is saying, here's the date when, if you're owning the stock on this date, on the date of record, you will get the dividend. Because remember, transactions are happening every single day with stock. So people are buying and selling it. So who gets the dividend? Everyone that touched it in December? No, the company has to have a date of record. So they will have a date of record that says as of, for example, December 20th. Everyone that owns it as of the close of business, December 20th, is entitled to the dividend. So that's the date of record. Not given in this problem because the date of record doesn't require a journal entry. We just have a date of record. So that's who gets the dividend. Then we have the payment date. The payment date is when the company actually pays the dividend. So we don't declare the dividend and pay it in the same day. That would be logistically impossible or very, very challenging. So what they'll typically do is they'll say, okay, we're declaring a dividend today on December 15th for the shareholders of record on December 20th, and we're going to pay it January 4th. So we have a date of declaration, we have a date of record, and then we have a date of payment. So we have 3 dates, only 2 in this problem because only 2 require journal entries. Let's go back. So then the other interesting thing about this problem is we have preferred stock and we have common stock. We calculate the dividends differently for those 2 kinds of stock. Preferred stock is the dividend is listed as a percentage, and that's all you will ever get for preferred stock. So preferred stock, 8%, you're taking 8% of the par value. That's all we do for preferred stock. Preferred stock doesn't get a higher dividend. Preferred stock simply gets an interest rate, pretty much, is what they get. Preferred stock is called preferred stock because preferred stock gets their dividend before common stock. That's why it's called preferred. They're preferred in that they get paid first. If anyone gets paid, preferred stock has to get paid first. So if you have a lean year and you don't have money to give out for stock and you just have a little bit of money, your preferred stockholders are going to get it. Okay? But they will never get more than 8%. That's all they will ever get. So preferred stock really acts kind of like debt in that you pay the 8%. The way it isn't like debt is you don't have to pay that. You never have to pay a dividend legally unless you declare it. Okay, and whereas debt, you have to make your debt payment. Okay, so let's dive into and common stock is a per share dividend, and it can be whatever they decide. So let's start with the first one. So we're going to talk about what journal entry we do for declaring the cash dividend. Now we have 2 cash dividends here we're paying. We're paying 1 dividend, but it's 2 different parts. We have the cash dividend on the 8% preferred stock. How we're going to do that? It's 8% of the total par value. So 8% of $200,000. So that would be $16,000. They're going to pay $16,000 as a preferred stock dividend. So you may want to note that. And then 15 cents per share on common stock. We have 40,000 shares times 15 cents. And again, we've got a par value on the common stock that we don't need. But that's okay. We don't have to use every number that we're given. So I'm putting up the journal entry here so you can copy it down and then I'll talk about it a little more. I've got the calculations in the journal entry that's going to appear. I'll talk about it in just a minute, but there's the journal entry for paying that, declaring the dividend. On this one, what we're doing, retained earnings. When we declare a cash dividend, we're impacting 2 things. First of all, we are recognizing we now have a legal liability to pay that dividend. So that credit to dividends payable, that's what sets up the liability. So we set up the liability with that credit to dividends payable. Now our debit, dividends reduced retained earnings. It's a return of capital to the owners is what it's actually considered. To calculate the dividend, again, we have the preferred stock. Preferred stock is always the rate times the par value. So 200,000 par value on our preferred stock times the 8% rate. That's the dividend on preferred. Common stock is always the number of shares times the per share amount. So preferred stock dividend, preferred dividends and common dividends are calculated differently. Preferred dividends is always a rate looking like an interest rate, but it's a rate. And common dividends are always a per share value. So that's how we get the amount. So what's happening here in this, when we declare a dividend, the day we declare the dividend, we have our retained earnings reducing and we increase a liability. So that date of declaration, we have a new liability on our books. Okay, next item down is doing the journal entry for the cash dividends on January 4th. So now we've gone through, we set up the liability, we've gone through year end, and January 4th we're actually paying those dividends. So when we pay those dividends, what's happening is we're paying out cash. So we know we're going to credit cash. And the amount should be pretty straightforward because we just wrote a journal entry for it. So it's that total amount that we just had. And then we're reducing the liabilities as well. So I'll put the journal entry up. And I'll talk about it in a minute. It's this one, date of payment. It's this one, date of payment. It's the third one. What's happening here on January 4th is we're paying the dividend. So we're mailing the dividend checks out or paying them electronically. So that top entry, the debit to dividends payable, that's reducing our liability. That's actually wiping it out. And then the credit here is the cash that represents the cash we are paying out. Now we had two journal entries here for this problem. We had this one, and these, by the way, are both journal entries I would put on my exam reference sheet. This is paying a cash dividend. The one we just had was declaring it. So we have a journal entry to declare it. We have a journal entry to pay it. Now the next question here in this problem says, did retained earnings increase or decrease during 2012? Okay, by how much? So what I've got coming up loading on the screen to answer that last question is, so that last question says, did retained earnings increase or decrease during 2012 by how much? So what I've got up here are the two journal entries we just did. I just put them on one page. So you have them in your notes. So the question is, did retained earnings increase or decrease during 2012? When we look through those two journal entries, retained earnings is a specific account. So what we need to do is we need to look through there and we see we have a debit to retained earnings for $22,000 and then we have no other retained earning entry. So whatever the answer is going to be, it's going to be $22,000. So that is going to be part of the answer. The other part of the answer is a sleeper because we tend to forget about it. We also, up at the top where I've circled, it told us that we had income of $85,000. Retained earnings is impacted by two things. Retained earnings is impacted by net income or loss and dividends. Okay? So when it asks us, did retained earnings increase or decrease during the year, we have to say, wow, okay, we know we had retained earnings decreased by $22,000 because that was the amount of the dividends. But we also had net income. Net income increases retained earnings. So retained earnings is increased by net income. It's decreased by net losses. We don't have a loss here. And it's also decreased by dividends. So we've got a situation here where we will have the increase of $85,000. We will have the decrease of $22,000. So the net will be a $63,000 increase in retained earnings. So NI, net income $85,000, dividends of $22,000, and that leads us to a $63,000 increase in retained earnings. Okay, what I want to do now is, what I want to do now is I want to end class now, but before we end, before you bolt out the door, I want to talk about what we're doing on Tuesday. So on Tuesday next week, we've actually completed, in the Chapter 10 videos, I'll give you a heads up, the Chapter 10 videos this week, I actually walked through a couple of the homework problems. So we have homework problems that we just did, and we have some in Chapter 10 videos. So that is all the homework. So actually you can do Chapter 10 homework anytime after finishing those videos. But what we're going to do Tuesday, I want to experiment a little bit. I have a whole series of multiple choice questions on Chapter 10 because I want you to watch the videos. I don't want to do them now because I'll just be explaining them all. So I have a whole series of Chapter 10 questions. So what I'm going to do is I'm going to bring in, I'll bring them in hard copy so you'll get a copy. And we're going to take the first 10 minutes or so of class, and I'm going to have you answer those, and then we'll talk about ones that people struggled with. If you have a laptop or a smartphone or a tablet, Monday or Tuesday would be a good day to bring it because we're actually, I want to experiment with something. I have a new technology for fall that I'd like everyone to try with me on Tuesday. So we're going to do, like, I hate to use the word quiz, but we're going to do a quiz that doesn't count, but you'll have questions. The questions you're getting are on your attendance quiz next week. So it benefits you. We'll talk about what's wrong, what you get wrong, and walk through there. So you're not going to be writing questions on Tuesday, but you will be doing a whole bunch of questions on Chapter 10. Okay? Have a nice weekend, and I'll see you next week.